So there's a lot going on in the market, and a little bit of it is under the hood. If you take a look at the SPY, that's what I usually like to discuss. That's the S&P ETF, and it's been making a series of. It's sort of been in a range. We've been in a big range for the last like 8 months or so, and the one thing that's a little bit notable is that we're making a series of lower highs and lower lows in terms of where rallies are terminating and I would say declines are resting. The good news is that it's all sort of relative and there's no real technical damage that's been done here. It's just been this chop consolidation. The important levels that I see here with regard to the S&P, I had discussed a little bit on my impromptu call-in today for Shadow Trader with Brad, that this 210, 209 strike has a lot of open interest, and that area needs to hold. If it doesn't, we're going to probably come back down to the 207s fairly quickly. That's really the big gap fill from the rally that started on after 710 that really got kicked off on 713. There's also some important Fibonacci levels there. It's also the 61.8 Fibonacci retracement from the entire move from that 204.11 low to the 213.18 high. Now, there's also, in that 210 area, is also the 50-day moving average. So I would think that a hold there, and if we can bounce off of there, I think that would embolden the bulls a little bit. If we fail there, I would say that the shorts are going to probably, like I said, try and press to the 207s. The IWM has been showing a lot of relative weakness. It's close to that 61.8% fib. That's at 123.62. The good news there is that it's still sort of held. It's holding where it needs to hold, and anything above the 120.97, I think, is still within the kind of the upper distribution of prices. Anything below there starts getting a little iffy, and there are some levels to discuss there. I would say that it's just it's in danger here of a lower high. If you want to play, I had discussed in the weekend video. I'm going to post the link to this past weekend's weekend video if you want to catch it. I had discussed that the 126.74 was a quote-unquote secure high, and if you want to play short against that, and that trade has actually worked out pretty well. If you take a look at IWM, I would say you probably want to do a little trim and trail if you took that play, and the stop here, if you want to move it down to preserve profits, I would say anything above 125.80 is getting a little bit too high for a rally, but that swing, that secure high there is held. If we can take that out, then I would say the all-time highs are in play, and maybe we would be discussing some Fibonacci's extensions, but let's take it at one range and one level at a time. Qs have been the relative strength. I had discussed that I thought it was getting a little bit extended. The healthy levels for a pullback would be somewhere between 111.16, which was the breakout high. That would be the most bullish if that holds. However, there is a little bit of room for a give if it wants to get back to 109.42. I believe doing some type of put ratios where those strikes are sort of your long strike, and then you have short strikes below them would work out well for me. I'm going to look to put those on. The issue with the ratios is that you can't put them on into strength. You really need the IV to be a little bit stronger. So the idea is to put them on into weakness, and then that widens out the sort of the strikes that you can use, and then you build it out. You build out the trade from there. If you want to know the 109.42, like I had discussed, was the sort of the middle of the range, and it also coincides with a 61.8 Fibonacci retracement of this entire kind of, I wouldn't say blow off because it's not really a traditional, it's not a sort of enough for a blow-off, but of this big move up. So I would say that that or below there are good lower strikes if you want to do some ratios. So we had some earnings that reported this week, and early on in the week we had Google and Netflix, which kind of just knocked the ball out of the park, and it took a lot of stocks with it. It took Apple up with it, and it also took Facebook up with it. So Google was a little bit odd in the sense that it ran $50 and then ran another $100 on their numbers. The kind of best tech I would say to play now, believe it or not, though, is still Google. They beat the numbers. They kind of crushed. They also have a good quarter behind under their belt, so to speak. And in this market, we tend to use the laws of inertia. Sort of an object in motion remains in motion until acted on by an outside force, and that would be earnings or some type of an event. The one caveat I'll say with Google is that the ECB decision, they're kind of trying to like break Google up, and that could be a bit of a wild card if it strikes. But for the time being, Google is still I would say the way to play it. The key for Google to go higher is really to clear and hold over 703. That's the earnings gap high of day. We're just in the middle of range here. We kind of had a bit of a look above and fail the last 2 days. I think it's just still kind of digesting the move. If Google got below like 678, which was that range low, then I would say that there's probably risk of a partial gap fill. I don't know that you're going to get the entire gap fill, but which would take it, by the way, down to the oddly the 61.8 of the range, which is around 605. But I'm not really anticipating that as being the case, at least not right away, and not without bounces and lower highs and stuff. A 50% retracement roughly of the gap would take it around to 657s. So I think that somewhere around there will probably catch it for a bounce. If you want to do ratios, you might want to use that as a, consider that strike. So Apple reported, and we know that their iPhone sales were a bit disappointing. Apple itself has just been in a very large range between these 119s and like 130. The upper end of this bar here was 134. So really the 33s, though, have kind of kneecapped it. So today there was a lot of fear mongering, particularly early after earnings. A lot of people like to just kind of shoot their mouths off and sound like they know what they're talking about when in fact they don't. And Apple had priced in about a $6 or so move, about 5 and change, and it had moved about $10, which is already a pretty large outsized move. So I know everyone had kind of came in long on Apple. That sort of was the bias, but some of the things to look out for, particularly with stocks that have large gaps, and particularly when they gap down or up, really, I'll discuss it both ways if you guys please. The low of day during the regular trading hours, I affectionately refer to that as RTH, never took out the after hours overnight low, which the spike down there was 119.20. And today's regular hours low, it basically, the stock started a bit of a bounce pre-market, and that was around 121.12, so that was sort of like the reference swing low. But if you were just go strictly RTH, that was 121.99. And Apple really never looked back. It rallied up. It got close to the 125s, which I had said I thought would be resistance. We got up to 124.55. It backed off. That swing low there was, I guess, your stop if you took the long. That was 122.96, and then the stock kind of just ground its way higher all day into what I see as a little bit of some resistance. My thinking on Apple here is the following. I don't know how, I sort of, again, this is going to be an order of operations issue here. I do believe at some point that it is going to fill the earnings gap back up to the 130s. It may do it immediately. It may languish a little bit and then do it. The key here, though, is the 125.62, and we're actually trading around there or a little bit above there in after hours, was sort of what was going to be the inverse head and shoulders neckline that we've kind of gotten through. So this might serve as some resistance. The 50% fib of the from the high to the gap low here was on like a retracement bounce would take it up to 127.48. And the 61.8 is 128.78. And the 50-day moving average is sandwiched in there just around 127.88. That area, I'm going to say, is going to be some mighty fine resistance, assuming we can clear and hold the 125s. The story with Apple, the reason the stock was down is I think it just had run up a lot ahead of earnings, and everyone had been playing long, and the market likes to inflict the most amount of pain on the most amount of people as often as possible. And I think that this kind of gave a lot of people with late entry hand slaps. The story with Apple, I would say, is the 119. If we lose, first of all, the 122s, if we lose 122s, we're going to see 119s in a blink. And the question is if we hold or we don't. I can't say if we will or we won't. All I know is ranges. If we lose there, the key levels will start becoming 114.86, which is the 50% Fibonacci of the entire run-up, and then also the 110.22 down to 109.03, which was the gap fill. I would say that area would be very strong support, at least near term, particularly for a right or right out entry bounce. I'm not really that bullish on Apple here short term. I just think it needs to probably digest a little bit more, and there's going to be some questioning whether they've peaked or what have you. I read on an online article that Apple recently made a order for 90 million iPhones for the 6S and the 6S Plus. That is a record number of iPhones, and they announced that they're opening up a lot of new stores in China. The China numbers, I don't think were super-duper weak like the media wants to make them out to be. They weren't really all that amazing, although the growth year over year was quite impressive. But with regard to analyst estimates, Apple still wound up missing its iPhone sales estimates by about 3 million phones. In the scheme of things, of the 47 million they sold and like the 200-something billion dollars they have on hand now in cash, is it a big picture? Company is still fine. Short term, though, the momentum is probably going to shift to Google. I would caution people of, looking to say that the lows are necessarily in Apple. The stock never, makes it easy. It never kind of follows anyone's rules. It just does what it says. There's probably a Carl Icahn tweet lurking somewhere that's going to give the stock a bounce. I would be using that to maybe play to book some profits. If you're underwater, you might want to use that to get out a little bit better. I had been in the play. I had been short weekly 125 puts, and I'm long, I think it's like 30 days DTE, 130, 135 calls. I did it really small just to sort of be involved in the trade. It's funny how small could become big, particularly if your strikes are gap through, but I used my gap discipline with Apple, and I was able to hold those puts short. Obviously the IV crushed, and I was able to get out of them fine. The call spreads, I guess, I kind of need the gap fill to make some money on that. But if they wind up just being a zero, or if I wind up taking a small loss on them or a loss, it's really not that big a deal. I've played Apple really well over the last couple of years, and losing a point here or there is I never like to lose any points, but losing a point here or there is really, in the bigger picture, is not that big of a deal. Facebook is coming up with their earnings. As everyone knows, I've been really bullish on Facebook for a long time. I had said that I thought between 99 and 103 was the area to take some profits. The top tick in the stock was 99.24, so the lower end of that range triggered. I hope people were using that upgrade to book a little profits and weren't chasing. The stock is up ginormous off of those lows in the mid-70s and the low 80s, which I had said were the buy zones. If the stock winds up pulling back, the ahead of the print. I think it would set up better as a long than as if it kind of holds strong and keeps rallying into the print just because of risk reward setup. I believe that Facebook is growing quicker, their top line, than Google. I think that they have the accelerated revenue growth, which is sort of like the key to stock price momentum stocks going higher. They also are going to benefit, believe it or not, from Snapchat going public, because it's going to show just how cheap Instagram was snapped up by Facebook by. They're also monetizing business lines. They've been doing mobile payments. They're just kind of everywhere, right? I mean, they're doing everything right. They're the ones that have been monetizing mobile. They've been doing an amazing job. I still like the stock. I just prefer it on dips rather than chasing. The risk-reward sets up better if it comes back down into earnings. The kind of big risk I see is it coming back down to retest sort of the breakout zone of between like 89 and 85s. That's sort of like the 88s to 85s. That would be sort of the big pullback, and I would say the stock is still kind of quote unquote healthy and buyable in those areas. I don't necessarily know that we're going to see it. The stock might finally really take off. We'll have to see how the quarter is. One thing I'm a little cautious about is that Facebook has been kind of kneecapped the last couple of times because of foreign currency exposure. Every company that reported this week has cited that. Apple mentioned it. That was one of the big problems for Apple. And if Apple sees it as being like a gale force tsunami or whatever it is that Tim Cook had mentioned, Facebook is probably going to have a little bit of problems with that. And they don't have the quarter behind them yet like Google does, and the stock has rallied big. Just don't be too greedy. Take a little bit of profits. With regard to the foreign currency exposure, I'm going to jump into that for a moment. The strong dollar, if you factor in a couple of things, I had tweeted this out today. I said strong dollar plus commodities crashing equals deflation risk, which equals lower for longer. The Fed has mentioned before they are aware of the strong dollar. I fully expect that to be mentioned if it holds up strong like this into the next Fed statement. I believe that the Fed doesn't really have an impetus to raise anytime soon because of the weakness in Europe, the weakness in our economy. The GDP here has been stall speed, and the strong dollar is not going to do much to help overseas companies, and crashing commodities are kind of not in line with the Fed's mandate of price stability and full employment. There is no price stability here. If anything, there is deflation and crash risk with regard to commodities, which, believe it or not, could translate over into the stock market. So just be kind of careful with that. The litmus test that I think people are looking at here are oil. That's now making fresh lows. It did not hold that $50 level. That was really key. I think that there is room down to retest into the 45s as long as we are below 50, which will be great for consumers, which will be good for restaurant stocks. It will be not so good for oil companies, although Exxon today got a pretty nice upgrade from Goldman Sachs. It didn't really translate. Originally, the stock had rallied a bit, but it didn't translate much into sustainable gains. I have been slowly nibbling on the oils, Exxon being one of them. I do believe that there is good reference support here. If you start losing the 81s, you might want to step aside a little bit. I really would like to see it recapture over the 83s, really 83.5, to kind of make it a quote-unquote big boy position. It's just kind of a little tester, feeler-outer here. With regard to commodities and feeling out, I've been nibbling slowly and smallly on silver, SLV. The ETF had made a really, really large kind of crescendo low. It wound up being a bit of an island reversal, although these lows are being challenged again. 14 there is, for me, a really hard stop. Anything below there, it's kind of GTFO, and just wait, for it to kind of settle out. It has not been making new lows with gold. Gold has been down so many days in a row, so sharp, so steep. Volume is just exploding. I believe a lot of people are kind of finally capitulating here, throwing it up. And the issue here is starting to become rate of change. I think there's a lot of hot money chasing the short here, a lot of people capitulating and puking. I'm looking for this somewhere between like around 144. That was the GLD. That's sort of like the GLD launch breakout range. I don't know if we get there in a straight shot. There might be some order of operation stuff, like all these people who have been chasing the short get a bit of a squeeze. There could be a bit of a bounce. SLV tends to be the leading momentum indicator here, and it's been stronger than gold. So that's how I'm playing it. If like I said, though, really it's a right or right out issue. The weakness in copper also kind of has my recession radar ears up. This has been a pretty breathtaking move down in copper. We had a pretty big one. We had a subsequent rally with a lower high, and now we're making some lower lows. This has to be on the Fed's radar with regard to the I guess their interest rates. I mean, commodities are crashing. I mean, I don't really see the big rush for Janet Yellen to want to raise interest rates. We'll see. If we start making fresh lows in copper again, there's going to be some recession chatter. TLT is going the right way for a lower for longer thesis. It's back up close to the 120s. I see 123 as sort of the upside risk. That was where the real breakdown took place and where the reference highs are. It's also the channel. It's also the channel top. If we start breaking out of that, the 127 gap fill could come into play. If that happens, I guarantee you're going to hear recession talk. Short term, it'll probably be bad for the stock market. Bigger picture, as you know, stocks are valued on a discounted cash flow model, and the lower the risk-free rate is, the better it is for stocks and for their prospects of still going higher. I am a little bit cautious with equities, as I said. It's also not seasonally the best time of year for stocks, the summer. If we do wind up getting a summer rally, I will revisit that probably in September and October, which is when there tends to be a little bit more headwinds with regard to seasonality in the markets, if there is a strong summer. Let's get to some of the stocks you guys had mentioned that you want me to talk about. In order, Tesla. I believe the stock is strong as long as it can hold 265. You had a downgrade of the stock. That also, not to jump, we'll jump back to Apple toward the end. We'll kind of end on that again. We hit it, and I'll end on it again. Tesla had a bit of a downgrade. It's been coming down the last couple of days. I actually prefer it lower into earnings as a setup. If it comes in on highs, we all know that gets a little bit dicey with regard to risk reward. Netflix and Google are more the exception than the norm with how that works. I think that had kind of started to be the pattern with up into earnings and then ripping. Apple kind of broke that cycle, so I'd say the fever for that is definitely tamped down at the very least. As long as Tesla's above 265 on a closing basis, the old all-time highs in the 290s are in play. Anything below there is a little bit more iffy and in chop range. If it starts losing the reference low, the reference pivot of 254.31, that would also be a loss of a 50-day moving average, which is still a little bit higher, around 257. So in that range, then I think that there is some risk to a little bit lower into the 240s and maybe even the 220s. We'll see how that plays out. But I am on the whole fairly constructive on Tesla, although I will say that weakening oil prices probably won't help that or the solar stocks. Ambarella is kind of had a bit of a blow-off top. It's corrected a lot. It got it just stopped just shy of the 61.8, which is really annoying. I had been looking to buy in there, and of course I didn't get filled. And it's even worse seeing the stock rally up again. This has been the story of the year with a lot of stocks not fully checking back to where they should. I don't really have much to say on Ambarella. I would say that it's more of a buy the dips than a buy the dip stock. I don't really like chasing after multiple days up. It is possible that it does make a higher high. The stock seems to be in vogue. GoPro had fairly decent numbers. that stock was sort of flat today. I think I prefer personally Ambarella over GoPro, but GoPro, the key level for that is any pullback. I think to, let me just look at this chart. And it's sort of just hugging there. The 60s, like these 60s, 61s, this is really where it needs to hold over. I would say 59.73 is sort of the line in the sand. Anything below there to me starts getting a little bit more iffy. It kind of looked below the 54s. It's rallied back up. There's a lot of shorts in this name. We'll see how that works with them covering. It was up multiple days. I think people would want to just kind of see how this can digest the move. The range low before the breakdown was really 61s. It had broken, then they kind of tried to reclaim back over it, almost to 70, and then it broke down again. So this is kind of a key area. Like I said, I actually would favor Ambarella more on dips than GoPro. I don't believe longer term GoPro has got a sustainable competitive advantage. In the short term, the stock will likely go higher. Particularly if it gets over the earnings gap high a day. Chipotle was one of these stocks, also I guess sort of Google-esque, although that wasn't so clean. If you were watching it after hours, it got pretty smashed, and the stock wound up rallying back up. A lot of their concerns are with these rolling blackouts of their pork. Doesn't that sound attractive? I'm actually a big fan of Chipotle food. I'm not such a big fan of the stock. I had gotten burnt on it once a few years ago, and I don't really mess around with it for earnings. I did say, though, that, and this was the play for today, it was a buy over the opening balance high of day. It never really looked back. The highs are a little bit poor. It is into some reference highs. It would not shock me to see the stock pull back for the next couple of days before resuming higher. If you're one of those momentum type of players, you want to give it 3 days, and then if it can clear at least 3 days, and then it can clear the 729.65 high of day here, then you'll probably get a move higher. The channel high would be, if it happened tomorrow, 829. Believe it or not, I don't know if we're going to get there. In the weekend video, I'm going to put on a Fibonacci extension of where I think this can go, but Chipotle, particularly if oil prices are coming down, will likely benefit from that. So I would say they sort of have the quarter at their back. A stock that could, the 1.618 is up near 800, by the way, 806. A stock that went down huge. They were down. Let me look at the intraday. 1 day, 5 minute. Yeah, after hour, this thing was down ginormous. Wow. It had gotten as low as 620. Oh my god. Then they reversed on their conference call. They had said that their situation was getting better. It wound up just completely rallying. It took back out that entire move, and then today it was up $50. It's like $100 plus intra swing move. That is pretty impressive. But a stock that can't go down, or I shouldn't say it did go down. I think it ran a lot of people's stops, a lot of the chasers. I would say that, though, that Chipotle is a buy the dip stock, as long as it can hold between on dips, as long as it can hold over the what was the spike high here? 699.03 to 692. You probably on dips can sell puts below those strikes, and then near dated, and those be relatively safe. If you want to buy, you need to see it hold half of today's bar. That's really the key. Anything below there starts getting a little bit more iffy. Qualcomm, I had said this in the on the stream. They're doing some type of split up. I know they have some activism. I'm sure at some point they'll figure out how to get this stock higher. In the meantime, it is not very well liked. It doesn't really do very much in regard to holding its after hours gains, and you can see I just pulled up the chart. It's already lost them, and it's trading below. So Qualcomm is probably going to need to clear the spike high here of 67. If it can clear there, it probably has some legs. If not, though, you're kissing the canvas lower. A lot of these chip stocks have just not been doing well. If you take a look at like Intel, for example, that has been kind of weak. It's actually looking like a classic, I just want to pull up a little bit more time charge here. It is actually looking like a head and shoulders breakdown. There is primary trend and a gap fill right here and slightly lower. The gap fill is at 27.97. So this is sort of, if you're bullish on the stock, you don't have the earnings risk here with it. You can do a right or right out play here for a long, or if you want to do a short, you really need to see this area snap. I would say that there's probably, since it's multiple days down into this, getting that kind of the rollover isn't going to right away. It might not happen the first shot. I'd probably be more interested in shorting this thing on rallies than trying to press the lows for lower, particularly now that we're coming up on trend. If anything, I would maybe be looking for like a real quickie bounce play. But these chip stocks are not looking great. SOX is very important. If that rolls over, and it already starting to here, we broke trend again. I had discussed a while back, this was back in October, that we had broken trend, primary trend, and I was a little surprised that we were able to get back up over it, although we did, and we made new highs. We have broken trend again, and now we are roughly around the kind of reference lows of a pullback. If we start losing much more here, I think that that's going to start really getting a lot of media attention, and that could start getting a little bit fugly, if you know what I mean. I'm going to do some work on this one for you guys. I'm going to do that in the weekend video, particularly with the Fibonacci retracements I see here, and I really like to key on this because I think that this could be a pretty big deal if we start losing, much more here. I would say that we're at one of the fibs. There's one a little bit lower in the 620s. You don't really want to see that get lost. If that starts getting lost, then I think the market is going to be in a lot more trouble than I think people realize that it could be in. Win has been having a lot of China weakness. I think a lot of people had realized that they, with the sort of the corruption and regulation issues they've had there, that they were better off playing the stock market. The Chinese stock market has been getting smashed. The Win is getting a bit smashed. I know he recently was involved in a divorce. I do believe, though, that this area is pretty key for Win around the 98s. If it starts losing there, there could be, believe it or not, some room down to the 82s I see on my chart. I would probably be more of a, I'm just cautious on Win. I don't like to be sort of bottom pickers. The stock is down a real lot from the old-time highs. I would say that I'm probably looking to be more of a buyer of the stock here than first shorting it. Maybe if there's a final whoosh and washout, that to me could be to get a little bit interesting on Win. I already discussed Facebook, and I think I'm going to end on BABA. BABA got up to the 100-day moving average, and the stock got a little has been doing some interesting stuff. I had mentioned on 7-8 that BABA didn't make a new low with FXI, and that the double low there was to trade long against. That trade wound up working really, really well, although it has been sort of a labor of love. I discussed today, labor of hate, actually. The stock is just such a mess. But, hey, if it's making me money now, I'm happy about it. If it starts losing this 80-21 I had said, I thought that was going to, 80 really was the stop. I would move that up now to today's low of day, 82. If you start losing that, I think the stock may have some room back down, believe it or not, even to 80. So, excuse me. I do think that there could be some room up in here. There is some resistance around 85. You have a 50-day moving average around 86. Also, the in the 85s and near 85, 86 is the 50% fib. That was also sort of where the real breakdown took place. So I would be taking some profits there, and there might be a little bit of a pullback. I do think that they have a big lockup in September, and somehow they're going to figure out how to manipulate the stock higher. And we may be talking about some, fib extensions at some point with this, with regard to the range. Not for all-time high fib extensions, but range fib extensions. I will discuss that more on Sunday. And I said I had wanted to end on Apple again, just because that's so big and so important. Just keep an eye on this on Apple. You know, Apple is sort of the proxy, right, for the generals of bullishness in the market. And one of the things that had disturbed me about this whole rally was that Apple wasn't making new highs with the Qs, and we are now kind of in danger of losing the range. If Apple does start losing the 119.75, you might want, you know, that wasn't, what was the low of this? Hold on, it was a little lower here. It was a 119.22. So if we start losing 119.20, which was the overnight low, it may retest. If it retests and hold, that's okay. But if you start losing that area, you might want to start thinking that the market is sort of transitioning from bullish to bearish. Keep an eye, you know, on some of these stocks. That's my my take on this. It's a little early to call that, but I am a little bit cautious, particularly with Apple short term. I do think that there is an order of operations and that there could be a gap fill at some point. It's just a matter of if we're going to retest that range low or if we're going to do the gap fill first. But we'll see. Anyhow. That's my story here, and I'm going to stick to it. If you're not following me on Twitter, my handle is @JustinPulitzer. Be sure to follow me. Subscribe to my YouTube channel. That's Justin Pulitzer Trades. And if you caught this intro video and you want to see it from the beginning, I'm going to post it on my YouTube channel tonight. I really suggest people subscribe to that YouTube channel. I post my weekend updates, and if you miss the tweet or what have you, it sends you a email notification, and you get to see the both my weekend updates and also my Periscope rebroadcast plus special edition videos. Anyhow, let's have a good rest of the week. I look forward to doing my weekend video. There's going to be a lot more covered in a lot more detail, and let's have a good rest of our week, and cheers.